There's a meeting happening right now that you're not invited to. Actually, dozens of them. In Basel, in Beijing, in boardrooms across the Gulf states. And the thing being discussed isn't just money, it's who gets to decide what money even means. While you were watching your portfolio, something shifted. Not a crash, not a rally, something quieter. The kind of change that doesn't make headlines until it's already irreversible. By the end of this video, you'll understand why the dollar's dominance isn't ending with a bang, but with 1,000 small handshakes you'll never see. Let's start with what happened in October 2024. Saudi Arabia and China completed their first oil transaction settled entirely in digital yuan. Not through SWIFT, not through New York. The trade cleared in seconds through systems most people didn't know existed. The price of oil didn't change. Markets barely noticed. But 37 central banks immediately sent observers to Beijing the following week. Here's what makes this different from every other dollar collapse story you've heard. This isn't about replacing the dollar. It's about routing around it. And the infrastructure to do that is already built. The global financial system you think exists, the one where dollars dominate and New York and London call the shots, that system is still there, still functioning, still massive. But next to it, in parallel, another system is materializing. One designed specifically for countries that are tired of asking permission. The question isn't whether this second system works. It already does. The question is how much of global trade it can absorb before the first system notices it's losing weight. So how does money actually move between countries right now? If Indonesia wants to buy Brazilian soybeans, both countries convert to dollars first. The transaction routes through New York correspondent banks. It takes days, it costs fees, and crucially, it leaves a data trail that the US Treasury can read. This isn't a bug, it's the feature that's kept the dollar dominant for 80 years. Want access to global trade? Use our currency? Play by our rules. But here's what changed. In 2015, China launched CIPS, the cross-border interbank payment system. It was clunky at first, slow adoption. Then Russia got cut off from SWIFT in 2022, and suddenly CIPS had a motivated customer base. Today, CIPS processes about $500 billion worth of transactions daily. That's still small compared to SWIFT's $5 trillion. But 5 years ago, CIPS was processing $50 billion. The growth curve isn't linear anymore. Then there's mBridge. If you haven't heard of it, you're not alone. It's a wholesale central bank digital currency platform backed by the Bank for International Settlements. Sounds boring. It's not. mBridge lets central banks settle cross-border payments instantly without touching dollars. The pilot program involved China, Thailand, the UAE, and Hong Kong. In one test transaction, they moved $20 million equivalent between countries in under 3 seconds. No intermediaries, no dollar conversion, no New York. The project went from concept to live pilot in 3 years. The BIS gave it a cautious endorsement in June 2024. Then something interesting happened. Saudi Arabia asked to join. Then France sent observers. You see where this goes. This isn't political theater, it's infrastructure. And infrastructure doesn't care about ideology, it cares about efficiency. Now let's talk about what this actually means in numbers. The dollar represents about 58% of global foreign exchange reserves, down from 71% in 1999, but still dominant. That dominance comes with an extraordinary privilege. The US can print money to pay for imports because the world needs dollars for trade. It's estimated this privilege is worth somewhere between $40 and $70 billion a year in reduced borrowing costs. But here's the thing about network effects. They're stable until they're not. If the dollar's share of trade finance drops from 60% to 55%, that's annoying. If it drops to 45%, that's a crisis. Because at that point, the self-reinforcing loop reverses. Countries hold fewer dollars, so fewer transactions use dollars, so fewer countries need to hold dollars. We're not there yet, not even close. But the direction is visible now. Look at what happened with Russian oil after sanctions. Western buyers pulled out. Russia was supposed to collapse. Instead, they rerouted supply to India and China at discounts, settled in rupees and yuan, and kept pumping. Production barely dropped. The sanctions worked politically, but the oil still flowed, just through different pipes. That's the template. It's not about confrontation, it's about workarounds. The UAE is positioning itself as the neutral zone. Crypto flows through Dubai, yuan through Abu Dhabi, dollars through DIFC. They're building redundancy into the system, which is exactly what you do when you think the main highway might get congested. And then there's gold. Central banks bought 1,000 tons in 2023, another 900 tons in the first half of 2024. China and Russia aren't publishing exact figures anymore, but estimates suggest they've accumulated over 6,000 tons combined since 2008. Gold doesn't yield anything. It's barbarous, as Keynes said, but it also doesn't rely on New York's blessing. And when you're building a parallel system, that matters. Before this turns into dollar doomsday propaganda, let's be clear about what's not happening. The dollar isn't collapsing. International debt is still denominated in dollars. Energy markets still price in dollars. If you're a developing country, you still need dollars to import basically anything. That gravitational pull is immense. Europe tried to build a euro-based alternative to dollar dominance for 20 years. It barely moved the needle. Why? Because having a currency isn't enough. You need deep liquid capital markets. You need rule of law that investors trust. You need a military that can protect trade routes. The US has all three. China's markets are enormous but not fully open. The yuan isn't freely convertible. Capital controls mean you can't just pull money out if things go wrong. That's a deal breaker for most institutional investors. So the yuan won't replace the dollar. Neither will the euro, or a basket of currencies, or Bitcoin. But here's what can happen. The dollar remains dominant, but its dominance erodes from universal to partial, from 95% of the room to 70% of the room. That 25% that opts out, they're not waiting for a better replacement. They're building workarounds that don't require one. This is fragmentation, not replacement. And fragmentation might actually be more dangerous. Because if the world splits into a dollar zone and a non-dollar zone, both with functional infrastructure, then every trade, every sanction, every policy decision becomes a choice about which system to use. And choice means leverage shifts. Zoom out for a second. What does a multipolar financial system actually feel like? More options for countries. Probably more volatility. Definitely more complexity. Central banks already struggle to coordinate monetary policy in a dollar-dominant world. Imagine that with 3 or 4 competing systems. There's a reason the Bretton Woods system was designed around a single anchor currency. It reduces friction. Everyone knows the price of everything in one unit.
It's a pleasure.
Contracts are simple.
Likewise.
Hedging is straightforward. In a fragmented system, every invoice becomes a negotiation. Do we settle in dollars, yuan, or a commodity-backed token? What's the exchange rate? Who bears the currency risk? These aren't trivial questions. And here's the geopolitical edge. Financial fragmentation mirrors strategic fragmentation. If China can offer countries an alternative payment rail, that's leverage. Not just economic leverage, political leverage. Want a Belt and Road loan? Great. We'll settle it in yuan through CIPS. Need to import Iranian oil? We can help with that too. No dollar exposure, no sanctions risk. This is infrastructure as influence. It's slower than military power, quieter than diplomacy, but it compounds. The US has used dollar dominance as a foreign policy tool for decades. Sanctions work because they cut countries off from the global financial system. But if there's a parallel system, sanctions become optional. And optional means negotiable. That's the shift, not the end of American power, the end of uncontested American financial power. So where does this leave us? The dollar isn't dying, but its monopoly is aging. The infrastructure for alternatives is live, tested, and expanding. Central banks are diversifying not because they hate the dollar, but because they've learned that concentration is risk. Maybe this leads to a balanced, multipolar system where trade flows more freely. Maybe it leads to financial Cold War blocks and volatile crises. Probably both. But here's what's certain. The next time you hear about a country signing a trade deal in yuan, or a central bank digital currency pilot, or a new cross-border payment system, don't dismiss it as noise. Those are the bricks. The foundation is already poured. And construction moves faster when you're not asking permission. The map is being redrawn. The question isn't whether you'll be affected, it's whether you'll see it coming.